Hey everyone, it's Monday morning, March 31st, and welcome back to Capital Markets Quickie. I'm your host, Endrit Sella. Since it's Monday, that means it's time to dive into the big market movers for the week ahead. It's going to be a busy one, so let's get straight to it. Before we begin, a quick note. Today's episode is sponsored by AMF Capital Asset Management Frankfurt. For tailored investment solutions and top-quality mutual funds, visit amf-capital.de. Alright guys, one more thing before we get started. Today is a special day, and I want to wish a very happy, wonderful birthday to my beautiful mother. Cheers to you, and here's to many more beautiful birthdays to come. Now let's be real. Last week wasn't exactly a cheerful one for investors. Stocks took a hit across the board. The S&P 500 fell almost 2%, the Dow lost about 2%, and the Nasdaq, well, it led the declines, dropping more than 2%. That puts the Nasdaq firmly in correction territory, down more than 10% from its highs in February. So what's going on? A big part of the story continues to be tariffs. President Trump's next big move is expected on Wednesday, April 2nd. He's calling it Liberation Day. And yeah, markets are bracing for a fresh round of reciprocal tariffs. The question is, how high will they go? According to analysts over at Goldman Sachs, investors are expecting around a 9% tariff rate. But Goldman thinks the number will come in much higher, maybe even double that. They're arguing that Trump will likely start with an aggressive number just to use it as a bargaining chip. We've seen this kind of playbook before with Canada and Mexico. High tariffs go in, markets freak out, and then the administration walks them back. Still, this time could be different. Some on Wall Street, like Barclays' Ajay Rajadhyaksha, are warning that April 2nd might be a much bigger deal than people think. He's calling last week's auto tariffs a statement of intent, and not something markets can easily ignore. And it's not just tariffs. Inflation is making headlines again, and not in a good way. On Friday, data showed prices rose more than expected in February, while consumer spending came in weaker than forecasted. Then, just an hour or two later, consumer sentiment from the University of Michigan showed inflation expectations jumped to 5%, the highest since November 2022. That sent stocks tumbling, with the S&P 500 falling about 2% just on Friday alone. So yeah, fears about stagflation are creeping back in. You know, that uncomfortable mix of stubborn inflation and slowing economic growth, not exactly the combo investors like. And that brings us to the labor market. The March jobs report drops Friday, and it's going to be a big one. Economists are looking for job gains of 135,000, down from 151,000 last month. The unemployment rate is expected to hold steady at 4.1%. But here's the kicker. Morgan Stanley says the risks are tilted to the downside, meaning unless the job growth number comes in way above expectations, it could reinforce concerns that the economy is losing steam. A miss, even a small one, could weigh heavily on sentiment. Meanwhile, over on the corporate side, it's been quiet on the earnings front, but there's something worth watching. More companies than usual are issuing negative guidance. So far, 68 out of 107 companies in the S&P 500 have warned that first quarter results will fall short of estimates. That's way above the 5- and 10-year averages. And with earnings season kicking off in full on April 11th, the big question now is whether expectations have been revised low enough to account for all these new headwinds, especially the tariffs. So, to sum it up, we've got tariff uncertainty, sticky inflation, shaky consumer sentiment, and a labor market that's showing signs of slowing. That's a lot for the market to digest in 1 week. Alright, that's it for today's Capital Markets Quickie. Thanks for tuning in, and I'll be back tomorrow morning to break down what's next on the radar. Until then, stay informed, stay sharp, and stay curious.